Welcome to our first video on the MF 101 Navigator series, where we talk through key mutual fund concepts in bite-sized videos. Today we talk of TER, standing for Total Expense Ratio, which is an annual percentage fee charged by the AMCs to manage and operate a mutual fund or ETF. You can think of it as your fund's maintenance charge. It is small on paper, but quite powerful over time. That is, for example, if your portfolio or your fund earns 12%, and the TER of that fund is 2%, then your effective rate of return is 10%. Now, the TER comprises charges which is categorized under three umbrellas: the BER, or the base expense ratio, and there are things like the fund manager fee, the admin costs, the distributor commissions, the marketing and operations, which is captured under this head. Then secondly, you have brokerage, which are the buy and the sell transaction charges and the SEBI turnover fees. And thirdly, but lastly, there are the statutory levies like GST, the STT, the stamp duty, etc. Now, how do you check the TER of your funds? TERs are disclosed daily like NAVs, and they are applied on a daily basis. So essentially, you can check the TERs like you would check your NAVs on the website of the AMC or the AMFI website, or they can be very easily gotten through any mutual fund research portal, an example of which I have included in the screenshot. Now, most importantly, how do TERs affect you as an investor? The TERs are spread amongst the different fund categories as follows. So, for example, the spread between the TER of a regular fund, which is invested via a distributor, vis-a-vis a direct fund, which is a fund which is invested directly via an AMC. So that spread is around 0.7 to 1%. Again, the spread of TER between an actively managed fund like an equity fund vis-a-vis a passive fund, which is an index fund, is again around 0.7 to 1%. Now, in the case of the actively managed funds, there is a parameter called alpha, which matters more. We are going to be talking about alpha in another subsequent video. However, the point to really note is that for the index funds and the ETFs, the TER is very important here, because there is no alpha game here, as these funds are simply tracking a index. Again, within the actively managed funds, there could be a difference in TER. For example, say we take a category of funds like a flexi cap fund. So a flexi cap fund of AMC 1 and the flexi cap fund of AMC 2, that could be different. Again, the difference could largely arise because the AUM, or the assets under management. So higher the AUM, the lower the TERs tend to go. For more such insights, please follow FinTech Mantras.